Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Michael Kelly, Global Head of Multi-Asset Investing at PineBridge Investments. Welcome, Michael.
Thank you, James. Happy to be here.
Great pleasure to have you here. Michael, in a global multi-asset investment strategy, what are the constraints, if any?
Well, you hear constraints with an investment product. Normally you think capacity, and that's often the case with security selection. It's not the case in moving between markets. The capacity in moving between markets, in our view, is having a broad enough network to be able to understand when asset classes are mispriced relative to each other. So talent, network, also patience. I know there's a proverbial multi-asset product that's going to catch every little wiggle in the market, but we think the more patient one is in deploying, those network talent type skills, the better off your results will be.
So within your available menu of global multi-asset investing, at the moment, what's an asset class or a subsector that's got you and the team really excited?
Well, the biggest challenge this year has actually been the real interest rate went conspicuously low, and it's pricing up, and that's taking the valuation of every asset class down at the same time. So the asset class strategy that we really like is one that's more immune to the real interest rate. We've been using commodity carry, which is a strategy often referred to as a risk premium by many people, where you're shorting the short end of commodities further out on the carry. Now, you want that forward out price to be well underneath the current, called backwardation. In the last 15 years, there are more commodities backwardated by the biggest degree in 15 years. So it's really set up to do very well. It's been delivering positive returns all year long, about 7% annual rate, 4% volatility, very fixed income like in a world where fixed income, as you know, has been a very challenging place. And really with a safer fixed income, you want to be able to hit the jackpot if everything goes wrong with the economy. And commodity carry has that characteristic. If we go into recession, you're going to make 20 plus returns in our view on commodity carry. Until then, you just chug along at 7%, but that's a plus 7%, which is a very nice thing to have in a year like today.
Is what you're really trying to do overall diversifying risk away from equity beta without reducing overall portfolio returns?
Well, we do seek CPI plus 5, that is equity-like, but we seek that with a third less risk than equity. Not simply by de-equitizing, but by looking at all the different asset classes and moving dynamically to when they are priced very well relative to their risk. And the secret there isn't structurally diversifying to a new group of asset classes that may also have growth returns. But including those, yes, but being more dynamic in moving between asset classes when the price is right and the forward fundamentals look right as well.
Is it all about really trying to deploy the risk level that you take on more efficiently rather than lessening risk overall?
We believe so. We have a element of our process called a risk dial score. And it's a very formal process. We look at how risk is priced in the various markets through our capital market line modeling. And when it's priced well, we do take more risk across the board. And when it's not, we don't. That's about 60% of how we dial up and down risk, and the other 40% is the directionality of fundamentals. Together, they've actually been a key contributor to our strategy over the last 20 years.
Michael, accepted wisdom about correlations has changed a bit in recent years. That some people might have thought they were set in stone, but the bonds equities relationship hasn't really delivered as people might have expected. So what do those changing correlations, what effect does that have on multi-asset investing?
They're pivotal. You're right that many people think that stocks and bonds always have a negative correlation. Hasn't always been the case. Actually, when you're in a very weak backdrop, equities and bonds react differently to weakness. Bonds celebrate, equities fear weakness. In an overheating environment, they're both vulnerable to overheating and how that activates central banks. We've had overheating periods before where the correlation flipped from its usual negative to its positive. So it is a key element when you're looking at the landscape on, are you going to be a slow landscape, an overheating landscape, a balanced landscape? Because you do need to anticipate that correlations can shift as the grounds underneath shift. We've had a very weak last decade, and now we're in this overheating decade, but the correlation shift that we've seen has been consistent with those sort of landscape shifts. They lead you to own more asset classes, not rely overly on stock and bond, because there's no diversification benefit in an overheating environment between stock and bond.
So what are, simplistically speaking, the assumptions about asset class returns on which you work?
Well, the assumptions, we actually spend a lot of time at PineBridge, top down, bottoms up, where we go up into a mountain together and sort of build out how are the cash flows going to grow over the next 5 years or shrink? How are the capitalization rates going to rise or fall? But why? It's a big debate, top down, bottoms up. We don't think either side has the right answer. We come out with a better answer together. And that's the pillar of what we do. It anchors our 5-year view of if we buy and hold what we should be expecting. We get all the benefit of the specialists who know that asset class really well, but their vulnerability can be that the more they know the asset class, the more they fall in love. And we have the ability to bring an objectivity layer to that, and together we do this, I think, very well.
And is it that the relationships between the asset classes and the changing relationships are a harvestable source of alpha?
Well, we believe they are. You do, again, we think, having a broader platform. So you have people not only doing the different asset classes, but doing them in different geographies as well. If you have that sort of broad platform, you have the basics of putting together something. But you also need a disciplined way to express that, and you need a little bit of patience. We find that you need about 9 to 18 months when you're right about the fundamentals for markets to reliably connect over that period with the fundamentals. So patience, network, and a process.
What role, if any, do factor approaches play in multi-asset investing?
Well, we like to think of them as a coach. Quite often, if you're trying to own 15-ish asset classes, as we do dynamically, we follow 80 asset classes. We want to own all of them over time, but only about 20% of them at any given time. If we like an asset class, we own it. If we love it, we own a lot of it. If we just are a little bit marginally positive, we don't own any for maybe 5 or 10 years. But when you're on the prowl for at least a dozen and a half asset classes, you can fall in love with 3 things that look very, very different. But a factor approach will tell you essentially the same thing. So think of that as a coach. Factors can help you really think through what are the fundamental drivers of each asset class, and are you investing in the same idea all over again with just fine shades of slightly different colors.
Multi-asset and all of those potential investments that you can make, and as you say, you're only in 20% of the possibilities at any one time. So would it be fair for investors to view that approach as all weather?
Changing weather, all weather within changing weather, yes. So as the weather changes, we're always looking for a mix that will do well in that mix. You know, earlier we were talking about how we set an objective of CPI plus 5 equity-like, but with a third less risk than equity. we did a 100+ year study and asked, can we achieve that level of return with the stingy risk budget we give ourselves? And if we created a set it and forget it mix of asset classes, the answer is no. But if you moved dynamically in front of the weather, and you'll never do that 100% of the time successfully, but in that 100-year study, it showed that if you did move successfully over 5-year periods and you evolved the mix as the weather changed, you could always create that type of return with that level of stingy risk budget. And so our objective is to, over rolling 5 years, do it about 2/3 of the time, get the bigger things about right. We feel if we do that, we'll continue to be able to earn a return of that magnitude, even in a high inflationary environment. In the past, it's been doable in war, depression, inflation. And so that's why we have a process, like I described on a capital market line, to see what the returns look like as the backdrop shifts. And then we also cull the attractive asset classes to only we have the most confidence in that their fundamentals will move in the right direction over the next 9 to 18 months.
I won't go through it asset class by asset class, but bonds at the moment must be a real problem child for any multi-asset portfolio. The US 10-year yield above 4%. What do you see going forward as how the bond market will pan out?
Well, that's really all a question about inflation. And we have not been part of Team Transitory, but we are now at a tipping point where, remember, we actually invoked something very similar to MMT. We did massive fiscal policies, and at the same time we did massive monetary thrust of the balance sheet, and that created a massive burst of demand that was paid for free, at the same time that we happen to have supply-side bottlenecks. So we have a wave of inflation. It is going to start wearing off. Unfortunately, it's not going to wear off completely because we also have a lot of intransigent supply-side issues that are building as this other faster-moving things recedes. So bonds, yes, they've had a stair-step function higher in yield, but that is a good thing going forward once they stop having a higher step function in yield. We think that normally comes with in and around the last hike. We think the last hike is somewhere around March of next year. And if we're right about that, long treasuries and gilts and the like should have a new mojo in their step 1 to 4 months in front of that. So we're getting close to the period you can enter the bond market again. We would recommend doing that in a very safe way. Treasuries first, investment grade second, and then somewhere 9 months from now, maybe high yield.
Let's talk about the US and recession. Do you think it will formally enter recession? And whether it does or it doesn't, is it that the markets have effectively priced in and acted as if it were already?
Treasury market has priced it in. The spreads in corporate bonds have priced in a very short and shallow, the immaculate soft landing. So the widening hasn't been what's commensurate with a full-blown recession. The equity risk premium hasn't priced it in at all. So that's not that unusual. Normally you have to get closer to the point where earnings start coming down fairly meaningfully. We did see the initial signs that something's changing in the June quarter. We'll see more, but it's not going to be earnings tumbling down in the third or even fourth quarter. So we're still in this waiting period between rates rising at a point where damage will be done, but it takes time and you have to wait for that damage to unfold, and we're in that waiting period. And until we see that, we don't expect corporate spreads to do their finale, and we don't expect equity risk premiums to begin building. But is there going to be a U.S. recession? There will be a U.S. profit recession. That's what we really care about. You don't buy and sell GDP. And the profit recession is on its way. We actually are 23% above trend in S&P 500 earnings. It's not a good buy point. And a lot of people believe that inflation is now good for profits. This particular inflation wave has been Prior inflation waves may have started that way, but the inefficiency that comes hand in glove with inflation takes margins down eventually as much as it takes top line up. And that's what we began to see the first hint of in the June quarter, where sales were up 12%. Normally when sales are up 12%, earnings are up, what, 15? This time they're only up 9. And sort of that margin degradation has begun. Profits will come under much greater pressure as we get into next year. And so it's just time to be patient and let the process play out and stay with a defensive mix that's very liquid, from which you can move after things really, unfortunately, fall apart.
I've been talking to Michael Kelly, Global Head of Multi-Asset Investing at PineBridge Investments. Michael, thank you very much for going in depth with me.
Thanks, James. Appreciate it.
Pleasure to have you here.